Hey, happy Monday, everybody. Brad Niccum Nest Mortgage Group here. Hope everybody had a great weekend. I've got a bunch of info in this video, really talking about the economy and things I learned today. So I think this might be helpful for everyone. I've had a lot of realtors and clients reach out with rate and refinance questions. It is great that we have started to see rates come down. I believe it's just the start of rates declining. So if you're thinking about refinancing, you may want to hold off just a little bit longer. And if you're thinking about buying, do not wait. I've already seen a huge jump in the amount of accepted purchase agreements that I've been getting, and on real desirable homes, multiple offers and over list price. When rates come down further, I believe we'll see that trend continue. And I have a few charts that are coming up that'll show you why economists say rates are continuing to come down. First, let's talk about the Fed fund rate. When it comes to the Fed and looking at how far away they are, it's interesting to see the comparison to the 2-year Treasury note to the Fed fund rate, where historically the 2-year Treasury note is the market maker. Figuring where the 2-year Treasury note should be, it will literally lead often the Fed's fund rate to follow. I'm going to show you a chart in just a moment that was really spurred on by discussion this morning on the show on CNBC, talking about the level of inversion where the 2-year Treasury note right now is significantly beneath where the Fed's fund rate is. And because of that, it's roughly 100 to 165 basis points below the Fed fund rate. This is an area where we have some historical precedent for where it could be and how it could lead into a recession or a recession indicator. The Fed's got to start being aggressive in lowering the Fed fund rate. Maybe not September 18th meeting initially, but surely over time, the Fed has a lot of catch up to do. There are, as I said, far away from where they should be. So let's take a quick look. You'll see that this 2-year note in red, and you can see how his moved much lower than the Fed's fund rate. The blue line is very far apart or far away from each other. You can see back in 2007 where this happened, we got these distances and the 2-year Treasury was leading the market lower, leading the Fed lower. Then the Fed had to catch up. But again, they were far way behind. They waited way too long and they couldn't hold off the recession, even though people thought that we wouldn't have a recession. They were sure that everything was just moving along fine. But sure enough, we got a big recession. People were saying there's no problem. And it's very similar to today. Now we have this in the opposite direction where the 2-year Treasury was staying way ahead of the Fed and the Fed again behind the curve. Too far behind, and the Treasury's rocketed up. So the Fed then initially moved up, but in small increments. Now the 2-year Treasury is way up there, and the Fed is playing catch up to get up to it. Assume something similar might be happening in the future, where the 2-year Treasury note will continue to move lower, and the Fed will have to start getting aggressive. That's going to be good news for all of us in the mortgage business. But remember, great interest rates and moving into a recession isn't always great news for the economy. Here's another report of the top 150 economists in the United States. It's called the Home Price Expectation Survey. When you look at 2024, there was a forecast for what appreciation would be on average throughout the country. The average from all of the participants was just above 5%. If you look at most optimistic, 6%. And even the most pessimistic people were thinking the housing was going to be weak and rest at 4%. Now, what kind of impact did that have this year based on a continuing year on a $500,000 home? You would have gained an average of $24,000. You could see 30,000 if you got 6% and 20,000 if you got 4%. So in any case, that's a meaningful change and an increase in wealth, and a great reason to buy a home if you don't own one. Now, what does that mean for the future? Well, the media is still, beating the drum that housing is negative, but the survey average is expecting a cumulative 20% appreciation over the next 5 years. That means that same $500,000 home, you would gain $100,000 in wealth. Even if you look at the most optimistic 32%, you gain 160, or the most pessimistic at 8%, you'd still gain $40,000. You're not going to do that renting. So it also tells you where housing prices are going for those people that are thinking about buying. If you're waiting because you think a recession means home prices are going to come down, This isn't going to be that kind of recession. Ahead of the Fed meeting on September 18th, we'll get some inflation data that'll come in too. This Wednesday, we'll get the consumer price index. Let's take a look at some of the early estimations. This, again, for the month of August, the headline is expected to come out at 0.2% month over month, which would bring down the year over year from 2.9 to 2.56. So again, another month showing inflation is coming down. Now, in the core estimates, they're going to come in between 0.2% and 0.26% month over month, leaving the year over year figure unchanged at 3.21. Now, we do have some things working in our favor that we should get a little bit more favorable reading in shelter because some of the rent prices and shelter away from home has come down. And also, we've received in the last 6 months lower oil prices that have continued to decline significantly too. So that really moves that energy side of the CPI. So hopefully that'll really show up in this next report. I know that's a lot of information, and what it really says is rates are going to continue to come down, home prices are going to continue to go up, and if you're thinking about a refi, it might be a good idea to wait. And if you're thinking about buying, now is the time. You can always buy a house with a little bit higher rate, keep your financials the same so you can refinance it when rates come down, and that's better than getting into a bidding war and paying over list for the house. So hopefully that's good information for you. Remember, my team here at Nest Mortgage Group, efficiency is what we're all about, continuing to offer 24 to 48-hour underwriting, condition clearing, including smooth, fast closings on all loan types for closing under 30 days. We're also still getting a lot of appraisal waivers for homes that put down, people that put down more than 20% on a home. We like to get that before you write the offer. That way you're in a much more competitive situation to win that house. If you're a realtor and you have a buyer that needs a pre-approval and it requires evening or weekends or holidays, don't hesitate to call me. I answer the phone all the time. I love to help get people pre-approved to buy a house. Thanks for tuning in today and have a fantastic week.